Welcome back. We're going to talk about how to profit from market volatility. This is important because the stock market is like a person with a yo-yo, hopefully walking up some stairs. But the fact is, when the market goes down, most people panic and they lose. So in this educational video, I'm going to help you understand that you can take advantage of that volatility and not lose when the market goes down, but make money when the market goes up. What's the big obstacle people have to overcome? It's to not lose money by just waiting it out. You know, Warren Buffett had two rules of investing. Don't lose money, rule number one. Rule number two, don't forget rule number one, okay? And so we want to transform for you an opportunity so when the market takes nosedives, maybe you're even cheering. You can actually profit from that and use what we call reset. So I'm going to show you some action steps on how you can have those downturns in the market work out to your benefit. So I'm Doug Andrew. I've been a financial strategist for north of 45 years, and I've found that a lot of people just are told to hang in there. The market always comes back. So let me give you a little story about my history. I began in 1974 with a Series 1 securities license. Now, they don't even offer that one anymore. I could sell any stock, bond, mutual fund, or whatever. And from 1974 until 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And we were doing our darndest to help these people not lose money when the market went down by diversifying and so forth. And we were trying to accomplish maybe 12% rates of return. Now, that sounds pretty good, doesn't it? But have you ever played red light, green light when you were a kid? See, there were some periods where we were progressing 20 steps, so to speak. But then the next period, we'd have to take 10 steps back, up and back, but we were trying to progress maybe 12 steps positive or forward on the average. Well, the fact of the matter is most people don't do that. If you bought and held, according to Dalbar, now Dalbar studies investor behavior in America. And if people would just buy and hold, they would probably average about 9.14%. So you're taking 9 steps forward, right? What happens is when the market starts to take a nosedive, people are told, hang in there. But when it drops about 30 or 40%, they finally say, enough already, and they sell low. And then when the market turns around, they wait until it gets really strong again, and then they buy. So what is that? That is selling low and buying high. And so the actual investor return for Americans is only 3.49%. In other words, if they bought and held, they might earn 9. But because they're buying and selling at the wrong time, they're reacting emotionally. They're only averaging 3.5%. So how do you overcome that? I'm going to share with you how not to have your money exposed to risk in the market, but be able to participate when the market goes up and then not lose when it goes down. So what does this mean in real life? You know, the worst decade since the Great Depression, it's often referred to in the financial services industry as the lost decade, was 2000 to 2010. I want to move it 2 more years to 2012. Let's say most Americans, if they had accumulated $1 million by the turn of the century during their lifetime, without adding a dime to that, they saw that $1 million dwindle because of market volatility, the loss from 2001 to 2003 because of 9/11, the terrorist attacks, 40%. So $1 million dropped down to $600,000 by the end of 2003. By hanging in there, it took 4 years to make back what they lost until 2007. You know, a lot of Americans had to put off retirement 7 years. They felt like they had lost their future. This is serious stuff. Well, guess what happened in 2008? As Warren Buffett put it, he said, when the tide went out, it revealed who was swimming naked. Well, a lot of these people had their money in the market thinking, now I can retire. And in one single year, 40% drop again because of the mortgage meltdown. Most Americans took 4 more years till about 2012 to be back to break even. During any given decade, there are generally 7 up years compared to 3 down years, okay? That decade, there were 5 down years. So what I did, and what I helped many people do, is during those 5 down years, they didn't lose anything. They didn't make anything, so they earned 0. Now, sometimes 0 can be your hero, okay? So they didn't lose, but the other 5 years, they made money. How did they do that? I got them out of the market. See, back in 1980, I got those 3,000 clients out of the market, and they were never happier. And so I began to link their returns to the market, to an index such as the Dow Jones or the S&P. And if you don't understand these indices, watch some of my other educational videos to learn them. But that allows someone like you to be able to participate when the market goes up. It may be capped at 12% or 15%, but when the market goes down, your money's actually not in the market, so you don't lose when the market goes down. And if you eliminate the losses and you get to participate in the upside, your average, do you know at 2000 to 2010, just by making money only 5 of the years and the other 5 not losing, people averaged 7.23%. But by simply rebalancing, they were able to achieve a little over 10.07%. I want you to learn how to do this. It's called indexing, and your money's not exposed to risk in the market. So actually, in 2008, a lot of our clients who got it and learned it were cheering. Go, go, because they weren't losing. And the first 90 days of 2009, many of them locked in gains of 16% the first quarter after not losing a penny. Everybody else in America had to wait till 2012, 4 more years, just to make back what they lost. What I'm sharing with you here is that at the end of that 12-year period, many people had 3 million who used this strategy of taking advantage of the market volatility when it went down. Other people were barely back to break even. I've often asked, what would you rather have? 1 million and a lot of heartburn for 10 years, or would you rather have 3 times that, 3 million, and be able to sleep at night? So I've talked about how to profit from market volatility, but you're probably still wondering, how do I do that? The key is to be able to position your serious cash, the money you are setting aside for future goals you don't want to jeopardize, but by understanding how to use indexing, not have your money exposed to risk in the market, but be able to participate with any upside potential during those up years. And so there's a strategy I want you to learn about how to lock in your gains during the up years and reset so that when the market dives, you don't lose. So I would encourage you to click on this video to learn more about how to do that.